Imagine standing in a dusty marketplace in the city of Ur 4,000 years ago. You aren't looking for a glowing green stock ticker, you're looking for a clay tablet. On that tablet, etched in cuneiform, is a contract, a loan of grain to a farmer with a promised return at harvest. We often think of investing as a modern invention, something birthed in a boardroom or coded into an algorithm. But the drive to turn today's surplus into tomorrow's security is as old as civilization itself. Think about the famous parable of the talents. We often use the word talent today to describe a natural skill like playing piano or woodworking. But in the first century, a talent was a unit of weight, specifically about 75 pounds of gold or silver. In today's economy, one single talent was worth between $500,000 and $1 million. When the master in the story handed out 5, 2, and 1 of those talents, he wasn't just giving his servants a job to do, he was handing them a massive, life-altering portfolio to steward. The story of human progress is the story of how we manage that weight. From the spice-laden ships of the Dutch East India Company to the birth of the New York Stock Exchange under a buttonwood tree, the tools have changed, but the heart of the matter hasn't. Whether it's a 529 plan for a toddler or a diversified pension for a retiree, we're all doing the same thing, planting seeds for a harvest we may not even be the ones to reap. Today we're zooming out. We're looking at the 4,000-year timeline of investing to see how we got here and how you can apply these ancient principles to your modern life. Welcome to Plan to Prosper, where we exist to honor God by helping faithful servants steward their finances wisely and build wealth that endures for generations. All right, Logan, we're finally back.
Yeah, it's been a while.
Yeah, the two of us in the studio together for an episode of Plan to Prosper.
What do they call it? Crossing winds or crossing ships? Ships, I don't know.
Yeah, something like that, where we're just passing by.
Passing ships, something.
Yeah.
There's some kind of form of speech.
Analogy, saying.
Everything in my head is going blank right now, which
That's
is
okay.
a good setup for a podcast.
Not a great start, but we'll get it together in the next 20 minutes or so.
I tried to take a look at whether or not you pronounced that word correctly, but I couldn't even read how to pronounce it. So
I was wondering why you were texting yet again during my cold open. I noticed it, but I actually looked it up ahead of time, and it is cuneiform, as I understand it. At least that's one of the ways to pronounce it. But
okay.
I stumbled over it. And
what is it?
What is cuneiform?
Yeah,
it's like the ancient form of writing.
Yeah, okay.
Like that's what you'd find on the etched in the caves.
Makes sense.
Those archaeologists, but they would discover cuneiform writings on cave walls and stuff like that.
Okay.
We're not gonna pretend to be like history experts or anything today, but that is actually what we are going to be doing. We're going to be experts in history for the sake of this podcast.
Oh, we are experts.
True. We're going to do a broad overview of the history of investing. We're going to look at, I forget if it's 5 periods of time, something like that. Maybe more than that. I should have looked at it, how many we were doing.
I've got one more good one that I didn't tell you about.
Okay, great. So a handful of periods of time. We're just going to speak very broadly about them. We're not going to go too deep into any of these, but we want to just look at, mostly because it's fascinating to me, and maybe it'll be fascinating to a listener as well. How did we get where we are today? And I think it's helpful to zoom out a little bit every once in a while and see how we got to where we are. And maybe it'll help us appreciate where we are and the ease of which we can do this now, as opposed to what we would have had to do 4,000 years ago to get any sort of return on our money.
You don't think we're about to give the deepest dive anybody's ever gotten?
It could be. I haven't looked into who else has done something like this. So
all right, we'll see.
Yeah. So we're going to start in ancient Mesopotamia. And we're going to start with the Code of Hammurabi, which was written in around 1750 BC on this, it was this, what's the word I'm looking for? Like granite stone, this like long, tall, black stone. It was etched into this thing. It was kind of a code of laws, basically, for how they would govern themselves back then.
Yeah. And part of that was some forms of how to invest, or some laws around, not invest, but some laws around like interest rates.
Right.
They were fixed back then. We think that mortgage rates are pretty high now, but you had interest rates at 20% for silver and 33% for grain. So enjoy your mortgage rate now.
Yeah, well, I saw that it was like they ran off of a system that like basically we're trying to coordinate with the year. So 12, how they got to that 20% number. I'm going to mess up how we got there, but it was something like 1/12. That's not 20%, but the inverse of that is potentially how they got there. Nah, I can't remember now. I looked into it, but how they got to that 20% number. But that is what they kind of fixed the interest rates by law in the Code of Hammurabi. And these laws were etched, or these debts were etched into clay tablets. And so,
like each separately.
Right.
Yeah.
So like that was what you would have this all written out on this clay ledger, and that was your contract essentially. And what's funny is like if that thing broke, then it was gone. Like the debt was canceled. So it was pretty important that you made sure you took good care of that thing.
If you were the borrower, though,
well, I would think that it would be held by the lender.
Yeah.
So that they would take extra special care with that thing.
Throwing rocks at them.
But I think I also saw that like the king would have the ability, like if the clay ledgers got too heavy, I don't know if they literally got bigger with the bigger debts that they were doing. Like he had the ability to like destroy them himself, if he felt like it was going to destroy the economy of his people, basically.
So there's always been government intervention, apparently.
Yeah, those government bailouts.
Yeah.
Even back in 1750 BC.
Too big to fail.
Right, exactly. So like if a merchant wanted to expand, they would take on a commenda, which was a partnership loan where they could, again, use these clay tablets to gather some extra capital for themselves, but they would obviously owe that back with a pretty high interest rate.
Right, because there was some risk there. Like merchants could get robbed on their route, and so the financier is going to want to be paid for that risk.
Exactly. Yeah, and this idea is gonna come up again in a later example with the bottomry risk later. But yeah, they weren't investing money like we do today. It wasn't coins and paper dollars. It was grain and silver and things like that. So it was.
We still do it in futures.
True.
Trading.
True.
Land was also a big one for them, and also livestock.
Okay. Yeah.
Because livestock can either appreciate in value or provide income.
Yeah, that makes sense. So it's more based on the goods and services of the day. That's what most of the economy was based around, was kind of your basic essential needs as a human. Food, shelter, things that would naturally be profitable.
Yeah. And also even infrastructure. So like they would invest in ways to create more efficient irrigation for like farmland, which would naturally make the farm more valuable. But it's I mean, that's back in 1700 BC, and we still have infrastructure funds now.
Yeah, it's awesome. So you can see the threads throughout history that we're not that far off from this. The methods have changed, and certainly the way we do it is much more streamlined and advanced, but the principles are underlying all of it is still essentially still in place.
Yeah.
There were 282 total laws on this Code of Hammurabi. The ones specifically dealing with money, finance, only a handful of those. So the code was much more broad with what it was addressing, but there were some specific financial principles that.
Yeah, the code was like their overall government, right?
Yeah, I think so. Yeah, social contract, and social norms, things like that. But it did address economics a little bit, and it's kind of where we wanted to start today.
Yeah.
Before Christ. But then we're going to fast forward a little bit.
All right, wait, real quick question.
Yeah, go ahead.
What's the difference between BC and BCE?
I actually crossed out the E on mine because that was a mistake. BC is before Christ. BCE is the way that the world wants us to say it now, which means before Common Era. They wanted to take Christ out of it, but that was my bad for leaving that in there when I was quickly.
I'd never even seen it.
Yeah. So, that's what it is.
Good to know.
So we're going to fast forward a little bit. We're still BC, but looking at in Scripture, about 1500 BC, we've talked about this. We did a whole episode on this actually when we looked at Joseph and his story in Genesis 41. So we won't go too deep, but you can listen to that episode. I don't remember what the number is, but it was on Joseph's plan for budgeting for Egypt. As you recall, the Pharaoh had these dreams that Joseph interpreted and realized that there's going to be 7 years of abundance followed by 7 years of poverty. There's 7 years of famine. And so Joseph came up with a plan to save 20% of all that was produced in the years of abundance to prepare for the years of famine.
Right.
So we have kind of this first savings plan. I mean, probably it's not the first time somebody came up with saving, but this was a way to hedge yourself against future years of turmoil.
Yeah, kind of like a risk management system. Yeah, I would say kind of that first big example of we see a risk coming and we're going to prepare for it.
Yep. So he was hedging himself against the future famine by really preparing well in the years of abundance, which is amazing too. That like the Lord gave that gift of the 7 years of abundance first, so that they could prepare for these 7 years of famine. The Lord didn't just drop 7 years of famine on Pharaoh and Egypt, even though he could have, and they would have had to deal with that. But instead, the Lord's like, it's almost like he's telling Joseph through what he's going to do, like, so you better prepare.
Yeah.
Like, use these years wisely because the drought is coming. And I think that's a wise lesson for all of us. Like, no matter what season you're in right now, if you have any sort of abundance or prosperity, like, just make sure to use that wisely.
Yeah.
Don't squander that. Make sure you're saving. Make sure you're setting aside some of this extra that you have, so that if and when the emergencies come, you're prepared for that.
Yeah. Yeah, definitely. I also thought kind of that the first recorded kind of economic hedge or risk management, would you consider Noah's Ark to be one of those?
Yeah, I mean, obviously it's different because God chose one family in this situation. He didn't give this principle to everybody, like, you all should build an ark. Like, I'd be curious if, like, all the people that, like, mocked Noah for what he was doing, if he's like, there's a flood coming, and instead they were like, you know what, I better prepare for that myself.
Yeah.
Like, that doesn't seem to have happened. God pretty clearly, like, just chose to kind of reset with Noah. So yeah, it's a good question, but I think that's a unique one because that was God's inserting it into redemptive history, kind of a little bit of a hard reset.
Yeah,
because of how bad things were getting.
Yeah, I agree. After that, there's some both like concrete examples and also, like, blanking on the word, but like the ant in Proverbs is not a concrete example, but just a good proverb about saving. But then there's also like the gleaning laws with Ruth and Boaz, where like each farmer had to leave the edges for the poor.
Right.
I would say that's kind of a similar example where they're preparing to provide for the poor. By making sure that they have enough to both provide for themselves, but also leave some for the poor to glean.
Yeah.
And then there was one other interesting one I found, advanced way ahead, but it's in Acts 11 there, and I feel like I just recently read Acts, and I just kind of skipped right over it, but it was clear that there was a famine in Judea, and the disciples in Acts decided to actually send relief to help the famine. So the disciples had enough that they could provide relief for a famine. That one's kind of similar to Joseph.
Would this have been around the time that they chose to elect deacons to help with that kind of a thing? Because
I think it was
shortly after that. Yeah, because in that context, there was, like, the disciples were so busy with the ministry of the word and prayer that some of, like, the practical needs were, like, they were having a difficult time managing all of that, and so they decided to come up with a new office in the church called deacon that would help more specifically meet the physical needs of the body, and while they continued to care for the spiritual needs. And so that's where we get that today. If you are at a church and you have deacons, that's kind of what their job is to help meet the needs of the church on a more, I don't want to say just practical level, because spiritual help is very practical, but more physical needs.
And in order to do that, you might need a little bit of savings.
Yeah, exactly. So this is why we always talk about having an emergency fund in place, because this is a great example of that principle. You are saving to a specific account and trying to build up enough reserve. We usually say 3 to 6 months of your essential living expenses, so that if you lose your job tomorrow, your family's not going to be putting everything on a 25% credit card and just racking up debt. Yeah. Instead, you have some leeway there, some coverage, some margin to be able to cover yourself in those terrible situations.
Right.
And Joseph did just that. Fast forward now to Christ in Matthew 25. He gives us the parable that we're all familiar with that I referenced in the cold open, which is the parable of the talents. I actually did not know this, how much a talent was worth.
Yeah, I didn't either.
I almost find it hard to believe that one talent is worth, in today's dollars, $500,000 to $1 million. Like, it's just a massive amount of money, apparently.
So that means that one servant got like $2.5 to $5 million.
Yeah, right. Wild.
Yeah.
And we've talked about this parable before, but the wicked servant wasn't punished just for losing money, because he didn't lose it. He kept it. He buried it.
He gave back exactly what was given to him.
Exactly. But he was punished for inactivity. And he's called a wicked and slothful servant for this. Yeah. Like, this parable always struck me as like, wow, that's wild. Like, he seems like he was doing the safe thing. Like, you know what? I do not want to lose this. I'm going to just protect it. But in fact, that was the wrong thing to do. He was to take that and steward it well to increase it. The master expected it to be put to use and not just hoarded away.
Yeah, it should really be a conviction against laziness.
I would actually love to know if the parable went in this direction, that servant decided to do something with it, but he invested foolishly and he lost all of it. What the master's reaction to that would have been. Would it be as harsh? I'm actually inclined to think not, that he would go, you made a mistake, but you tried your best. Yeah. And for that, respect. I don't know.
Yeah. I would say maybe not even invest, like, if I think invested foolishly, I think like kind of carelessly.
Right.
But like, yeah, if he invested in something that seemed good, you can absolutely invest in a company that seems good. You have a good thesis for it, and then something breaks down and it goes bankrupt or whatever. Yeah. So I think you can do everything right and still lose money investing. So yeah, in that sense, I think he would not have been reprimanded so much. Yeah.
Yeah, I'm not in any way arguing that just throw caution to the wind and invest in anything just to do it. That's not it. But I'm just curious. Like, his rebuke is so strong for not doing anything that I wonder what his reaction would be. Had he given it his best shot, but it just didn't work, and he lost some or even all of it.
Yeah. Yep.
I don't know. So, yeah, we're called to be good stewards of the money that we've been given. That parable makes that abundantly clear. It's an active thing. It's not just, it's not passive where you just hide it away. You are called to put it to good use.
And just rest on your laurels. Yeah, it's not that.
Yeah. God views buried capital as a missed opportunity for his glory.
Right.
So, okay, we're going to keep going. We're actually going back a little bit again, some of the timeline. We wanted to hit the biblical ones real quick, but now we're going to go back. We're now at 400 BC to the 1500s, and we're looking at in the Mediterranean, the bottomry contract. Can you explain what the bottomry contract was?
Yeah, so it was a loan for like ship captains that needed to get from point A to point B. But they needed capital for some reason, like maybe putting together crew, things like that. And so say they got 1,000 of whatever currency, dollars, whatever, from a financier. As long as the expedition was successful, so they go from point A to point B and then back, then they owe that capital back plus a premium for the risk that the financier took on that on that expedition. If the boat sank or whatever, they didn't know anything back, and so the bottom it was basically just referring to the bottom of the ship.
Yeah, which is so funny. Like the hull of the ship was the collateral itself that we're banking on the ship making it successfully from point A to point B, and if it doesn't, then the captain's off the hook. It's kind of funny. I mean, just because your ship sinks doesn't mean you sink with it necessarily. Although the captain is supposed to go down with the ship, so the idea of the captain not owing anything if he's at the bottom of the sea is kind of somewhat obvious. You can't owe any money if you're dead, but the collateral was the ship itself getting from point A to point B. An investor invests all this money into it and gets a pretty hefty return when the ship arrives safely. So it's kind of risk on both sides. Like the investor's taking a risk that this money that he's giving away is going to successfully fund this ship's voyage. Mm-hmm. And the captain's taking a risk too that he's going to be able to actually do it and pay back all this money that he's been loaned.
Right. Yeah. And it's interesting. I think on the financier's side, the lender's side, kind of the thought process, which is similar to something like a life insurance or whatever, is that you're going to fund enough successful voyages that the premium that lender earns will more than cover one unsuccessful voyage.
Yeah. Yep. And so this is a big shift in the investment, the way that people were thinking about investments, going from a debt-based thinking to more risk-based thinking, and how to. It allowed people with ideas like these captains who were coming up with, they were creative and trying to come up with ways to be profitable in their expeditions, to take these massive risks using someone else's capital. And I would think that it was very profitable for these captains as well, not just the investors who were getting this big return on the other side of the voyage, but the captain himself clearly is getting something in return for this too. He's making a profit because he's successfully going through these expeditions and selling and trading these goods that he's probably transporting.
Yeah, probably making a premium off of the goods that he's selling, things like that.
Yep. So it's cool. It's kind of like you said, it's a direct ancestor to insurance. First time humans figured out how to price risk, and figure out how to make it a profitable venture. Yeah,
because then later there was marine insurance where you're basically just covering the voyage, and captain can pay $50 to cover the voyage if something, which I don't know. Again, to me, doesn't make a whole lot of sense because what does captain care? Like he's probably going to be at the bottom of the sea. But
right,
there was later kind of a distinct separation between the protection and the credit risk. So just thought that was interesting.
Yeah. There's another kind of interesting note about usury, and so Scripture talks about usury as an issue where like don't charge interest on loans that you make out, and so the church banned usury in this era, which makes sense. So investors got creative, and instead of charging an interest rate on this, we kind of were sharing in the profit of the whole venture itself.
Right.
It was how it was phrased, so that they could. It's not like get around this, usury issue. It was more like it made sense that we were going to be all sharing in the profitable venture here.
Mm-hmm. Yeah, and obviously not if something bad happens.
Right. And then we're going to move forward to the Renaissance era, the 1300s to 1600s. And we're going to look at the Bill of Exchange from the Medici Bank. And
Italy, I assume.
Yeah, that's in Florence. This was a way, almost like the gold standard, basically. Like you instead of carrying around all these heavy gold bars if you were traveling, you could go to deposit your gold at a bank in Florence and receive a piece of paper that allowed you to go to a bank in London and get your gold back. Like it was basically a promise that piece of paper was worth what it said it was.
Yeah, I wonder how common scamming was back then, because it sounds like it would be so easy to scam a bank and like, oh, here's my piece of paper.
Yeah.
So I wonder, and it would be harder. Like these days, it's really easy for banks to talk to each other. So this guy says he can pull $500 out of the ATM. Does he actually have $500? And if he doesn't, then the bank says, oh no, he overdrew, and now I owe my bank, and all of that. I just wonder what that process was like back then.
Yeah. But it created this system of trust. This is the kind of where we get the word credit comes from the word credo, which we're familiar with as Christians. We recite creeds all the time, which just means I believe. And so we're creating the system of, we're trusting that this piece of paper that I got from one bank is going to, that another bank's going to honor that.
Yeah.
Yeah, I don't know.
Well, do you think it's more that, or I trust that this person actually has what he says he has?
I think it's both.
Okay.
Yeah. Like if I would feel it back in the day, if it's a long journey to travel and for whatever reason, let's say I'm moving from Florence to London, in the example given, I would be a little nervous giving all my gold to a bank and just getting a piece of paper in return, going on my long journey to London and then going, all right, now it's time for me to get my gold. Are they going to do it?
Yeah.
Like, is this legit? And that's a big risk on for the investor. But it is a risk for the banks too, that they're trusting that the person who gives them the piece of paper that is legit.
Yeah.
Yeah.
I also wonder how. I mean, it must have cost something, because then doesn't the Florence bank have to get the gold to the London bank? Like the reason you just gave was person moving doesn't want the hassle of moving all of his gold.
Right.
I just wonder how the banks ended up figuring out how to kind of settle all of that. Yeah.
Yeah. Yeah, it's interesting. But this is, 1300s to 1600s, creating this system of trust of how can we navigate moving capital when it was more, impractical to do so on a person-by-person basis.
Yeah, yeah. And just one more time on the point of kind of scammers and sin, and how kind of the money always drives sinful people to do sinful things. I wish I looked into it more. I'm fascinated with what scamming technology was back then, because now you kind of, you have both. You have really good technology to protect the investor and the bank and all of that, but scammers are getting better and better. I'm always nervous now, like talking even talking on this podcast, like, can a scammer pick up my voice and make me sound like I'm calling somebody else? Things like that. Yeah. Just the craziness of technology.
Yeah. Now you have me thinking, I wonder if the Florence Bank issues this piece of paper on their official, whatever they were using at the time. There was somebody that signed for it. It's stamped with a seal or an approval. That somebody at the London bank, their job was to go back to the Florence Bank, give them their piece of paper back, and go, give me all that gold. I'm gonna send it back to.
Oh, maybe.
I don't know. Anyway, yeah, it's interesting. So we're going to keep moving forward now to the 16 to 1700s, almost 1800s, and we're looking at the Dutch East India Company, or VOC. Yeah.
Yeah, first major company in which you could be a shareholder.
Yeah.
There was one other company back in like the 1300s where it's arguable about whether or not that was the first, but
okay.
Most people agree that it was Dutch East India Company, and it was the first one to like make it much easier to be a shareholder. So
to this point, you either had to own like a whole ship or a whole company. You couldn't just own a share of it.
Right. So now anybody, business related or not, could own a small portion of a company.
Right. So now a humble baker could own 1% of this company in his own little portfolio, because they made it possible to offer public shares.
Right.
There was one caveat: you couldn't sell your ownership until the ship came back. Like it was similar to the bottomry thing. Like we had to guarantee that this stuff actually arrived safely when they were making these voyages. So you weren't allowed to share mid-trip or anything like that in case the ship had sunk or anything. We wanted to guarantee that there was going to be a profit coming in.
Right. But it was also more of like an evergreen, almost like an evergreen fund in today's investing, where you didn't have to get out either. Like you could continue participating in the next however many expeditions you wanted to participate in.
Yeah. I saw that at its peak, the VOC was worth 78 million guilders, which is worth about $7.9 trillion in today's dollars.
Wow.
Yeah. Trillion with a T.
Yeah. I mean, that's like the large companies now.
Yeah. So this was like creating liquidity and democratizing wealth, made shares fungible where you could actually transfer them fairly easily. Again, you can just kind of see the journey, how we just got from the Medici Bank or whatever getting the piece of paper for your gold and then withdrawing that from another bank. This is a similar kind of even expounding on that further, where you could make your shares liquid, buy and sell them a little bit more easily.
Yeah. They issued the first dividend in 1610.
Oh, okay.
So yeah, investors were able to then benefit off of dividends as well. So they benefited off of dividends, but also the company grew in terms of like where they would travel and think like the different shipping destinations and all of that. So investors were able to kind of benefit both off of dividends and growth of the company. And then the other interesting thing that I found was that, and it's kind of another example of what wealth can drive you to do, the sinful things that wealth can drive you to do. They were, these days it would be completely illegal, but they were creating their own monopolies. By I can't remember what island it was, but they went to an island and like got rid of a bunch of trees that were producing fruit. Mm-hmm. And then started producing that at another island that they had more control over. So they had like created their own monopoly for this shipping route and getting this fruit and getting it back and all of that. So yeah, it was interesting.
I was watching Pirates of the Caribbean the other day, and
great movie.
Yeah, this was the first movie that I like really fell in love with as a kid. I saw it 5 times in the theaters, and I was like 12 years old when it came out.
Wow.
Yeah, like I don't know how I convinced people to keep taking me to the movies because I couldn't go myself. But somehow I managed to do it 5 times because I loved it so much. My first AIM username was Captain Jack Sparrow, 1991 or something like that. So that
respectable first.
Yeah, kind of. It was kind of lame, but whatever. I just loved it. But there's a scene right in the beginning of the movie when Captain Jack Sparrow saves Elizabeth from drowning. Yeah. And Commodore Norrington, he just was made Commodore in this scene, shakes his hand. Like he can clearly see he's a pirate. He doesn't look like you're, an upstanding citizen. He's got the whole look of a pirate. And so even though he just saved Elizabeth, they are ready to shoot him, basically. And Elizabeth is like, are you really going to kill the guy that's just saved my life? And he goes, you're right. I owe you a thanks. And he shakes his hand and then pulls up his arm, and he sees that he's branded with a P on his arm. And he says, had a brush with the East India Trading Company, I see. So I think pirates were getting involved here a lot and commandeering these ships to plunder and to, do their thing. I remember hearing that a lot because I saw this movie so many times as a kid. I didn't know what the East India Trading Company was, but they were out there doing their thing, and pirates were trying to take advantage of that.
Well, and we still have that. Like that recent Tom Hanks movie, I can't even remember the name, Captain
Phillips.
Yeah, that's it. I was even watching a video the other day of like one of the big container ships or whatever, like shooting a pirate ship.
Yeah.
Like a small little pirate boat.
Yeah. I remember hearing, like when that movie came out, I was like, wow, there's really still pirates going on. That's so cool. But then I'm like, but they don't look like the pirates from the old swashbuckling buccaneers with these cool swords and all this. It's more modern piracy, which is not that cool. You're just a sleazy criminal. But there was something romantic about the pirates of the 1700s.
Yeah, yeah. Because even my 2 boys like love to like Captain Hook, and they both have like pirate T-shirts. They just love it. They just think it's like a cool look. It
is funny that like those movies, the pirates movies, the protagonists are the pirates. Like Captain Jack Sparrow will eventually becomes a pirate, and you root for them when they're stealing and plunder. They're just all sorts of debauchery, but it's fascinating. Yeah, I love those movies. Okay, anything else on the East India Company?
I don't think so. This is where I'm going to interject with my other one, though, because it's very similar time period. You're aware of the tulip bulb craze?
vaguely?
It was the 1630s.
Okay.
And I've always loved this because this is like when I first fell in love with investing in college. It was, fun fact, tulips were not native to Holland. They originated in Turkey, but they were brought to Holland by a professor. The professor wanted a lot of money for it. A thief broke into his house and stole the bulbs and then started selling them at less. But it just created and then also there was this like disease that didn't kill the tulips, made them look even cooler, and so it just kept kind of driving prices up. And so it's kind of the first example of like an investing bubble.
Okay.
Because in January of 1637, the tulip bulbs increased in just that month, increased 20-fold, the price of them. And then in February of 1637, they decreased by a larger amount than the January gains. So like they got extremely volatile, but people were in the build up to this bubble that in February burst, people were bartering their land for tulip bulbs.
What in the world?
Like it got ridiculously expensive. They got ridiculously expensive. And then as the bulb burst, government tried to intervene by offering like 10% of what people bought. I think it was 10% of what people bought their tulip bulbs. But even that was too high a price for as the bulbs were falling. And so they finally landed on like being the same price as the onion, the ordinary onion in that day.
Are there any modern comparisons that we can make? Like it sounds crazy to put that much into something as, I'll say frivolous as a tulip, but the .com bubble comes to mind that like some of these worthless companies that were just going gangbusters in the late 90s before the bubble finally burst and realized these companies are worthless.
Yeah. Some of those mortgage-backed securities in 08. There are other things that I would argue that sound like could be a setup for this, but I won't get into what.
We'll just tease that. Talk to Logan if you want to hear his opinion on. I know exactly what you're talking about, so fair enough.
Yeah, reach out to us and I'll let you know.
Okay. Yeah, that's fascinating. Tulips. Any other thoughts on that?
No, I just thought it was a good example of investing and an investing bubble.
Yes.
From way back.
Yeah, very cool. So then we go towards 1792. So America is now in its early years. And there was a panic that took place in 1792. There was a speculator named William Dewar who tried to corner the market on government bonds and was able to trying to buy up all these to try to corner the market here, but he kind of defaulted on it on these loans, and the market kind of collapsed for 2 months in March and April of 1792, which led to 24 stockbrokers meeting in May of 1792, the next month, under the Buttonwood Tree on Wall Street. And they signed a one-sentence document to trade only with each other and to set a set commission, which was 0.25%. Called the Buttonwood Agreement, and this was what started the New York Stock Exchange.
Yeah, it's interesting to think about trading back then compared to now. Like trading back then was the broker would like walk into a coffee shop and just find somebody who wanted to buy whatever he was brokering.
Yeah.
So yeah, kind of like the Wild West of like, no, do you trust this guy? Like, is he selling for a good price? Yeah, things like that.
Yep. It wasn't this. The New York Stock Exchange is funny to think about. I wouldn't have guessed this if you just asked me what was the purpose of starting the New York Stock Exchange. I would have said, well, to generate massive profit. But that's really not what it was. It was built for protection, to protect investors and the people selling them. But kind of a both and thing. Eliminated these auctioneers from just going rogue or anything like that. And we're gonna make this a more reputable practice.
Right. And it was needed because Hamilton did a really good job of kind of creating a more reputable financial system. When America first went independent, people didn't know if they were going to be able to like back themselves financially and all of that. And Hamilton did a good job of setting that up. And so in that time period, it was, you issue a government bond. Can the U.S. government actually back it, though?
Yeah.
But then as Hamilton made the system stronger and stronger, it would make sense that maybe, and I'm just throwing numbers out there, but maybe when they first issue the government bond, you're going to pay $60 for it, for something that you might get $100 back, because there's a lot of risk there that you're not going to get it back, your principal back. But then as the U.S. continues to gain credibility, it's going to make sense that the price of that bond is going to keep going up, because now it's all of a sudden more credible.
Right.
And so that probably led to it led to Dewar, but there are probably lesser examples of people like kind of trying to make potentially even immoral profits off of it.
Sure.
Just by like sweet talking into, it would cost this, now it costs this. Like, how about you get in now? So just random things like that.
Yeah, and Hamilton was instrumental in getting them out of the panic. So that panic didn't last more than those 2 months.
Right.
Like he was able to step in and provide the capital needed to fix the issue, basically to stand for those loans that were being defaulted on by Dewar and all that. There was a couple other guys involved too. It wasn't just Dewar. But Hamilton really did a good job of navigating that well, so it didn't create this widespread depression or anything like that.
Yeah, yep.
And then it led to the birth of New York Stock Exchange, which is alive and well today.
Yeah.
So fast forward a couple hundred years now, and we're looking more in what we're familiar with in today's era of investing. And we're going to look at the accidental retirement plan that was discovered in 1979, 1980 by a guy from Philadelphia. So like all good things in America, the 401k plan was birthed in Philadelphia by a man named Ted Benna, who's a Christian, and he was like a benefit consultant. And he worked for this company called the Johnson Company, not Johnson & Johnson, but it was called the Johnson. It was like a bank that he was a benefit consultant for them. And he was wrestling with his faith. I read one story where he was like, I can't be a benefit consultant and a Christian. And so
why do you know why he felt that way?
Because there weren't the benefits available at the time just were offering very few. They were offering tax breaks to executives, but not to the employees. And he just felt conflicted that these employees weren't being treated properly. And so he was actually planning on going to work for a Christian college. I don't know which one. When he discovered the new Internal Revenue Code, the tax code, section 401k, that talked about executives getting a tax break to be able to defer some of their compensation for tax relief and kind of set aside some funds. He discovered this was intended for executives, but it doesn't say that.
Right.
There is no limit to who can do this. So this is when he created the 401k plan, where employees now could contribute pre-tax dollars into an account. And then he also combined that with an employer match to incentivize people to do it, because at the time, people were getting cash bonuses, and so the idea was, well, why would I defer a cash bonus and just tie it up to retirement? I want the money now.
Yeah.
But he was able to add extra incentive by let's combine that with an employer match, getting a pre-tax break on it, and let's incentivize people to start saving.
Yeah, that's fascinating. I should have looked up. I wonder what the tax rates were at that point.
Yeah.
But yeah, prior to that, it was pensions.
Yeah, right. So this was kind of the transition out of that as the norm. That's still the norm in a lot of public sectors, but in the private sector in particular, providing employees with a way to save for their retirement and incentivize them to do so. He has since, in the more recent years, claimed that it's kind of become a bit of a monster because of all the fees with 401ks, like heavier fees. But nevertheless, like his original vision has worked out fairly tremendously in that he has given people the opportunity to become savers, to get in the habit of setting aside money for their own retirement, to put the practice of Joseph into action, or the ant in Proverbs, and set aside money for their future retirement.
And I would say people have more control over their retirement now than they did under the pension. They were getting kind of what the company promised to give them. Now you have control over what you invest in within your 401k. I mean, based on whatever the company provides in the 401k plan, but you have the onus to invest. But if you do well, you can set up an even better retirement for yourself.
Right. Yeah, it's just so funny that like everybody knows what a 401k is, or at least has heard that word 401k. But like, how many of us realize that the reason it's called that, it's such a weird name.
Yeah.
It's because that was the section of the tax code where it was birthed from.
Yeah.
And he discovered it one Saturday afternoon in 1979 and built a whole plan off of it. It took a few years, but by the mid 80s, like only 5 years later, a good amount of private companies were starting to use these. I think he won an award in like the late 90s for creating it essentially. But it's just interesting that it's in the grand scheme of things, it's still a fairly new thing.
Yeah.
Right? Like we have people that would just be on the verge of retirement now that would maybe not have had access to this when they were in their working years. If they were working in the 70s and even 80s, this is a fairly recent phenomenon, but has become essentially the standard for most Americans saving for retirement.
Yeah. Yeah, and probably cheaper for companies. So it's kind of provided a dual benefit.
Yeah. And then, Roth came into the picture, and now there's Roth 401ks where you can eliminate the pre-tax benefit, but you get the tax break on the other side of it, which is pretty sweet too.
Do you know what that's named after?
Governor, or I think he was a governor, or
I think it was a congressman of Delaware.
Oh, okay.
So it's the Roth Bridge in Delaware.
Oh, is that right?
Yeah.
Yeah, I'm curious, when the Roth IRA came out, how soon after did Roth 401ks become available?
Yeah, I mean,
was it all simultaneously? I don't know.
I don't think so. I think because a lot of 401k plans still don't offer the Roth.
Yeah. Yeah. So Christians in Philadelphia just getting to work and doing the Lord's work here. Yep. So, any other thoughts on the 401k?
No.
We have one final one, and we just touched on this fairly recently.
Yeah.
So we won't go into in depth here, but the index fund from Jack Bogle. I know you have your thoughts on it, but in general, just the idea of pooling an entire index together, and instead of just buying individual stocks, being able to basically just buy the whole market and benefit from the overall returns.
Yeah. It was it's been useful since he came out with it. People refer to it as Bogle's folly because it just didn't make sense to anybody that you wouldn't want to try to just beat the market, or that you wouldn't want to try to beat the market. Why just kind of settle for average, get the average market returns? Why not try to beat it? The competitor in me loves that, but sure. I think there's a place for just kind of a core exposure to the markets in general.
Yeah, and it's helped a lot of people to be kind of a DIY investor, to simplify your investment life, buying a cheap index fund and just continuing to pour your money into that and letting it go. Because if you're going to do it yourself, most people probably don't have the time to become experts in all things investing. So it will simplify your life to do something like this and tie it to an index, as opposed to trying to pick the winners, and that could end poorly for a lot of people if you try to do that.
Yeah, I have friends whose like 13, 14-year-old kids are just, every time they get allowance or whatever, they're throwing it into an index fund.
Yeah, I think that's wise in its own way as you're getting started. We certainly think as your capital grows, it makes a lot of sense to talk to a financial advisor and maybe sophisticate your portfolio a little bit more, get broader diversification. But I think for a lot of people who are just getting started, an index fund is a great way to do that.
Yeah, agreed.
Well, that's our deep dive. Not super deep, but looking at a little bit broadly at the history of investing, because it's fascinating. And I think it's a helpful perspective to see where we are now, to maybe gain a new appreciation for it, for the simplicity with which we have access to this. A lot of us probably have a 401k that we're just automatically getting money deposited into on a weekly or monthly basis, and that we have the ability to build wealth that way in our modern age, as opposed to having to go to a clay ledger and have it etched in there and all these things. We have it pretty good, all things considered.
I don't know if any other podcast has done as deep a dive into Ted Benna as you just did.
Hey, Ted's my guy. So I think he's still alive. I think he was fairly old when he invented this in the 80s, but I think I saw that he was still alive. So maybe we could have him on the podcast.
If you're listening.
Yeah. That would be awesome. Anyway, any other thoughts before we wrap up here?
I don't think so.
Okay.
I think we did a good job covering a lot of stuff.
We did a great job, if I do say so myself.
Yeah, you do.
We'll be back for another episode next week. Again, we may or may not have a special guests on the show next week. That is the plan. The last time we said that, something came up and we had to reschedule it, but he ended up coming on the podcast. So again, Lord willing, we'll have a good conversation next week with a couple guests and talk more about all the fun stuff with investing, faith-based investing, and everything else that we like to do.
Yeah, it should be a good one.
Alrighty. Well, thanks for listening. Tune in again next week. God bless.
God bless.
Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. This material is intended for informational purposes only.